Hello, Dr. Tim Creel here. We're going to talk a little bit about Chapter 7 today. So let me go ahead and bring up the presentation, start the presentation. And Chapter 7 and Chapter 8 follow Chapter 9 and Chapter 10, they all look at different cycles. And what you're going to find in auditing is that they break down certain things into certain cycles because the cycles are related. And by auditing one, you cover evidence or create evidence for the other. So the first cycle is basically the revenue and receivable cycle. So let me go ahead and turn the page. So the revenue and collection cycle. I was saying receivable, but collection cycle. And think about it, these two are related because whenever you earn revenue, you're typically going to bill the customer and they're going to pay you later. They're going to pay you 30, 60 days later. And so those two are related. If you verify the sale, you can also verify the collection. Those two can be related. You verify the receivable, there had to be a sale for them there had to be a sale to support them paying you. So it's it's kind of like you break it down into these cycles in order to expedite the audit process. Because again, if you're checking one, you're gathering evidence for the other at the same time. So it only makes sense to do it this way, and it just makes the audit process more efficient, proves the efficiency of the audit. So the revenue and the collection cycle is what we're looking at in this chapter. We'll look at expenditures in chapter 8, and then we'll get into two other cycles in chapters 9 and 10. So you're going to see some of this over the next couple of chapters as well. So your book kind of at the beginning, near the beginning of the chapter, has like a big outline or kind of a diagram illustration of this process. And kind of think about the revenue and the collection cycle and what occurs. So the company receives and processes customer orders, and that includes granting credit. You always want to check credit whenever you're doing a customer order because so many times you're going to sell it to them, and basically the journal entry is going to be a debit to accounts receivable, a credit to sales or sales revenue. And so you're basically granting them credit. So one of the things you want to do as a company is always check credit in this process. Deliver the goods and services to customers. There's going to be typically a shipping area, and these products are going to be pulled, put together into a shipment, and they're going to be shipped out to the customers. Billing customers and adding to accounts receivable. So this is basically going to be a sales invoice, and then you're going to collect from the customer. And so this is kind of the summary of the process of the revenue and the collection cycle. So, a couple of things to talk about here within this cycle is you want to compare the subsidiary accounts receivable balances with the accounts receivable control account. Now, the control account is the total accounts receivable. This is what's going to show like on the balance sheet. Remember, accounts receivable is a current asset on the balance sheet. So that's what's going to show there. But think about it, all the individual balances to our customers are what's going to make up that total. So one of the things as an auditor you'd want to do is compare all the subsidiary balances to make sure that all of those agree with the total in the control account. You want to check the pending and back order master file. What this is orders that are pending means that they're in the process of being put together. Maybe one item is missing, and that would be the back order master file. What if a customer orders something and part of what they order is on back order? So if you can get it there pretty quickly, then you'll kind of set that order aside, wait till the other product arrives so you can fully complete their order and then ship it all out. Or what if it's on back order and it's going to be like a month? Then you might complete the part of it and then ship out what you've got. And then when the other arrives, you'll complete it. Um, so that's kind of like a pending and back order master file. And the thing is, what you're kind of doing is you're checking to make sure that one, the company is completing these, and two, you're kind of making sure as the auditor that these weren't completed, but they're still sitting here where there could be overlap. Like they could have been done, but just these files not have been updated. And then the company come back later and ship it out again. Double shipments and things of that nature is kind of what you're looking to prevent here, or looking to see if that's occurring as the auditor. The customer master file, this is where all the information about the customer is, including information such as their shipping address and any terms that you have with them as far as payment. All of that would be on the customer master file. And accounts receivable aging schedule. This is an important thing that the auditors need to check, because the aging schedule is a schedule of everyone that owes the company money, all the customers that owe the company money, and how timely they are as far as what they owe to the company. Like it'll list like all the customers, how much they owe the company, and these are, one column would be all the customer names. Second column might be how much they owe. The third column might be what's current, what's 1 to 30 days past due, what's 31 to 60 days past due, what's 61 to 90 days past due, and what's over 90 days past due. So you would kind of have it arranged something like that. When I've seen them in the past, they've always kind of looked like that. And what this would be is, again, it's a listing of not only all your customers, who owes you money, but how current they are as far as with what they owe you. One thing with the customer master file, let me take a step back to that again. It's important to know the addresses of your customers, because one of the things you're looking at as far as if it would come down to, examining for fictitious sales, for example, one of the things you'd be looking at is if a customer orders something, verifying that it's being shipped to the shipping address set up by the customer and not somewhere else. Um, Again, just kind of a check, and balances that you would be doing as the auditor. And as far as verifying internal controls, also with the customer file and with the aging schedule, just noting how often they're updated. Is there out of date information in the customer master file? How often is the aging schedule updated? Is it done monthly? These would be, really kind of examining the effectiveness of controls, because both of these should be considered effective controls that the company would be doing. So as an auditor, you might be observing how often are these updated. Now, a sales analysis report also could be here, which kind of analyzes the sales to each customer. That also could be examined by the auditors as well. These reports for as far as sales to each customer. Okay. Now, relevant assertions and risk. Now, remember, these are the management assertions. And remember, we talked about this with cash, that there are certain management assertions that go along with cash. We looked at that in chapter 6. The same thing here in chapter 7. There are certain management assertions that go along with revenue and accounts receivable. For revenue, it's occurrence. Did the sale actually occur? Completeness, were all aspects of the sale recorded? And cutoff, was the sale recorded in the proper period? A big thing to keep up with as far as cutoff with sales is making sure that the sale is recorded the day of shipment, the same time that it goes out in shipment. That's an important thing as far as the auditor and verifying that the sale was done on the day that it was shipped out, that it was done and put into the proper period. Accounts receivable, the management assertions would be existence. Um, does this amount that's owed to us by a customer actually exist? Completeness, is the record related to this amount of accounts receivable complete? Are there payments? Have all payments been recorded? Have all amounts been added to this total? Is it complete? And valuation here, which would be, um, you know, related more to the amount of receivable, and um, also here kind of related to the allowance account. And what I mean by that is, if this customer is past due and you're using an aging schedule, you know, with the allowance method, it really creates something where net accounts receivable, or the amount of that you feel like you're going to collect, may be less than total accounts receivable. So kind of your allowance method would come into play here, when you're looking at the valuation of accounts receivable. Now, the revenue recognition rule, it's in the chapter, and this is something that auditors must be cognizant of in relation to revenue. And that is the revenue recognition rule. And I've kind of written it out here. I'll just kind of read through this. Identify the contract with the customer. Identify the performance obligation in the contract. Determine the transaction price. Allocate the transaction price to the performance obligations in the contract, and recognize revenue when or as the entity satisfies a performance obligation. So this is really kind of the definition of revenue. So what you as the auditor would be looking at is, can they actually recognize revenue? Was this legitimate? Was it a legitimate recognition of revenue for the company? That's what you're looking at as the auditor. Now, the collectability of accounts receivable. Again, this might kind of go back to the allowance method that we were talking about earlier. And typically with the allowance method, the company will use the um, an aging schedule, or they'll use the percentage of sales or percentage of accounts receivable method. And they basically, in the same period as they make the sale, will write off a certain amount of bad debt expense for what they feel like they're not going to collect. And one thing to always remember is that when you're making sales on accounts receivable, there's always going to be times when you don't collect it all. There's going to be companies that are going to file bankruptcy and you're going to have to write it off. Customers could die. They could pass away before they pay you. There's just always going to be instances and things that occur that are going to keep you, that are going to not allow you to collect everything. And so the allowance method is a way in accounting that you're required to account for what you feel like you're not going to collect. And then you're also, once you feel like you're not going to collect a specific account, you need to go ahead and get it off the books and write it off. Those are all part of the allowance method. So you're going to examine to make sure that they're following the allowance method. They're recognizing what they feel like they're not going to collect, and that typically once or twice a year, they're writing off accounts that are uncollectible. Now, this is where an aging schedule does help, because the aging schedule will lay it out due to the date of when something is due. And so if something is way past due, you as the auditor might say, well, isn't it time if they had a lot of like over 90 days receivables, you might say, okay, isn't it time that you start writing some of these off? You as the auditor can inquire as to that. And so again, that's part of looking at the collectability of accounts receivable. You would also look at things like customer returns. And here's kind of something too in relation to customer returns you'd want to look at as the auditor. And that is, what if a company, um, it's kind of called like channel stuffing is kind of what it's called sometimes. And that is, what if a company sends out a bunch of orders right before the end of the year, but the customers didn't order them? And again, that's kind of where the auditor, you would come back and you would be kind of matching customer order, shipment, and invoice. They should all be related. But there are some companies that have been known in the past that if they want to meet a certain sales goal, they ship out extra goods to customers right before the end of the year, because they know either the customer is going to take it or they're going to send it back. But if they send it back, it won't be until the next month, and they'll have met their sales goal then for that year. And so one of the things you look at is a lot of customer returns right after the first of the year. If you've got like a good sales month in, say, December, and then a lot of returns in January, it might not be, that could be an indicator of companies over shipping product right before the end of the year to help their sales. Now, granted, that does not necessarily mean that's the case. When you're looking at things such as retail, retail is a little bit different because you've got more individuals and buying things for Christmas and then returning them right after Christmas. But this is a little different than that. This is more like lots of returns, like a lot of sales at the end of the month and a lot of returns early in the next month. Again, just something you'd be kind of glancing at as the auditor, or something you'd want to be cognizant of as the auditor. Now, evaluate internal controls. One of the things you want to do related to this cycle, and every cycle we're going to look at, is you got to evaluate their internal controls. You got to see how strong their internal controls are really in the planning stages. So entity level controls, these would be controls across the entity. So you want to evaluate the controls across the entity. You want to make sure there's proper segregation of duties. So let's put it this way. One person, one area should collect the customer order and put the order together. Another area of the company should ship out the goods. And another area of the company should invoice the customer. And another area of the company should receive payment from the customer. These areas should be separated. Make sure revenue is not recognized until they are able to do so. So you want to make sure that revenue is recognized when they can do so. Now, another way to kind of look at this as an auditor, and a good way to verify if controls are in place, is a three-way match of the customer sales order, the shipping documents, and the customer invoice. This all provides proof of a sale. And if all of these match, such as the customer ordered a certain amount, you can verify from the shipping documents that that was what was shipped, and from the customer master file that it was shipped to the customer's address, and then that there was a customer invoice sent. All of that provides proof of a sale. And basically, if all of those match properly, then you know that certain controls are in place within the company, because those three need to match. The customer needs to be shipped what they ordered, and the customer needs to be invoiced for the cost of what they ordered. Now, list of control activities to prevent fraud. Limit access to inventory and shipping areas. Limit access to billing terminals and blank invoices. You don't want anyone to have blank invoices, because they could create a fictitious sale and then send out an invoice. where you would have this full file here of a sales order, evidence of a shipment, and a customer invoice. You don't want to make it easy for someone or a part of your company to maybe create a fictitious sale and or ship too much, what we were talking about earlier, kind of the channel stuffing, in order to artificially increase their sales totals. Record receivables and sales the day the order is shipping, and record cash receipts when received. Customer invoices compared with the bills of lading. This would be a shipping document. Bill of lading would be a shipping document that says exactly what was shipped to the customer. And customer orders. So you want to make sure that whatever the customer ordered is exactly what's being shipped. And then they're being invoiced for exactly what was being shipped. And pending order files. Again, pending orders, these are oil orders that are waiting to be filled. Be reviewed often to avoid failure to bill and record shipments. So these are some activities that you could look at to evaluate their internal controls, and also to uh, you're basically also looking at how effective are their internal controls. And if you find errors and issues, like you find that they're not shipping the right amounts, they're not recording sales on the day that the items are shipped, you're not, if you find that they're not invoicing the customers for the right amount that was shipped, again, if you're finding problems like this, that means that they do not have a good system of internal controls, because internal controls should be checking things such as this. Okay, the test of effectiveness of internal controls. Client inquiry. Again, you're asking questions of the client. This might be through, we talked about an earlier chapter, questionnaires. A questionnaire would be where you send it out to the customers, and which asks the customers questions, and they give a yes or no answer, and any answer that's a no could indicate a possible problem with internal controls. You observe. You would observe basically orders being collected and making sure that they're basically giving the customer exactly what they ordered, and that they're shipping exactly what they ordered, and that they're comparing the two, and also checking that they're invoicing them exactly what they ordered. Um, Inspection of documents. Again, you can look at the customer order, the shipping documents, and the customer invoices. And then reperformance and walkthroughs. This might even be, looking at dummy transactions to make sure that everything was followed in accordance with the transaction. Did all recorded, and this is kind of a couple of questions to ask, and afterwards you kind of get your answer of kind of how the auditor could verify this. Did all recorded sales actually occur? And as the auditor, you could vouch sample of invoices to shipping documents. And then another question here, were all shipments invoiced? You could trace a sample of shipping documents to invoices. And so these are just kind of questions that you would ask as an auditor, and how you would look at that, or how you could kind of answer your question as the auditor. Now, other tests of controls: completeness of revenue and accounts receivable, um, accuracy of revenue and accounts receivable, um, accuracy of revenue, cutoff of revenue, and classification of accounts receivable. And basically, an auditor can test these controls by observing client processes, or vouching or tracing this information um, within the system to test the controls that are in place. Now, substantive procedures. Remember and test of details. So basically, remember that when it comes to I think this is just something Substantive procedures and tests of details. This is something that basically the substantive procedures, you remember, are the tests performed by the auditor to gather evidence to support their opinion. So substantive procedures are the way the auditor does that. And remember that they tend to be test of account balances or details and analytical procedures. These are the two types of substantive procedures that auditors use. So in terms of analytical procedures, the auditors could look at ratios such as days sales and inventory, or sales asset ratios such as maybe asset turnover ratio. And what these do, what looking at these ratios would do, and these are just a couple of them. There's more out there also. Profit margin ratio could be looked at as well. But what these ratios do is if you see a change from one period to the next, that might be something you as an would tell you as the auditor, why did that change so much from the prior period? And you would look at that. So analytical procedures really kind of helps auditors identify areas that they need to look at um, when doing the audit. And a lot of analytical procedures are done during the planning stages um, because they kind of help the auditor plan what are the areas I need to look at the most in the audit? What do I feel like is the most important? If you notice a certain ratio going up or dropping, that might be a sign, what happened there? I need to look at that, as the auditor. Now, a big substantive procedure that auditors are going to do with accounts receivable is confirmations. So what this means is the auditor is going to have the client fill out a form, and then the auditor is then going to send that to the client or send that to customers of the client in order to confirm their balances. And it could be a positive or negative confirmation. A positive confirmation would be like the client prepares and signs something saying, for our auditors, we're asking you to confirm that you owe us $100,000 as of December 31st, 2022. And they will then give that to the auditor. The auditor will then send that to the client, and the client will then return that to the auditor with their confirmation saying, yes, they owe us $100,000. That would be a positive confirmation. Or a negative confirmation would be basically, you don't have to contact us unless this amount is wrong. So again, a positive confirmation is confirm the balance, return it to the auditor. A negative confirmation is you don't have to send us anything unless this amount is wrong. If this amount is wrong, we ask that you tell us what amount you're showing as of this date that you owe this company. So confirmations with outside third parties are one of the strongest forms of evidence that an auditor can come up with. They're very strong because the balances are just being confirmed with the outside parties. Now, alternate procedures in place of confirmations. There are some, if now I will tell you this, so go back to confirmations real quick. Positive confirmations are deemed to be a stronger form of evidence than negative confirmations. And the reason being is that in a negative confirmation, you're not getting anything back to verify. And here's what happens in auditing. You send out these confirmations, and one of the reasons you have the customers fill it out, your client fill it out, is that basically the client is giving permission to the customer to verify this for you, the auditor, which is important. And so it's one of those things that you're typically going to send them all out and you'll get some back right away, but then you're probably going to have to send out another batch or two if you don't get them right away. And think about it, you're trying to do this in a pretty quick amount of time. And so typically you're not doing this by mail. Typically you're doing this electronically in today's world, which does expedite the process. But what you've got to decide is basically, you know, how many confirmations do you need to receive for you to feel comfortable about the balance? So what you're trying to do is to make sure you get enough confirmations where you feel comfortable that you've successfully tested the balance of accounts receivable. And so positive confirmations are just deemed to be better because you're actually receiving something back. A negative confirmation, it could mean that either the amount's right and you're not hearing back from them, or it could mean that the customer of the client just blew it off and never returned it. And so positive confirmations are deemed to be a little stronger than negative confirmations. Now, alternative procedures in place of confirmations. If you're not able to get enough confirmations, you could look at subsequent cash receipts. I mean, think about it. Um, one of the best ways to verify a sale is the fact that you received money from that customer. It's a good way to verify a sale. Um, Looking again at sales orders, comparing it to invoices and shipping documents. Again, that's a good way internally to verify a sale. And correspondence for past due accounts, you know, looking at what correspondence the company has sent or received from clients in regards to past due accounts. And again, this would be kind of going back to the aging schedule and looking at the correspondence sent to these customers or what correspondence those customers have sent back to the company. Again, this is kind of another way to verify, again, without confirmations that a sale has been made and also that an amount is due to the company in terms of accounts receivable. Now, review the collectability of receivables. Again, kind of an aging schedule. It's a great way to do that there. Sales cutoff test, make sure sales were reported in the proper period. Um, and what that means basically is that, again, you want to record the sale on the same day it shipped out, the same day that it shipped out. And if there's a difference, so that's what you're making sure is that if the shipping document says it was shipped out on the 18th, the sale was recorded on the 18th. That's what you're looking for there. If the sales documents say it's shipped out on the last day of the month, then the sale should be recorded as of the last day of the month. It shouldn't be recorded a day earlier or a day later. Examine if any, and this should be accounts receivable. This should actually be accounts receivable right here. But accounts receivable can be factored by a company. And what that means is that um, the company is selling the receivables in order to get immediate cash from them. And some companies like to do this. Some companies would prefer to get 90 or 95% cash now and go ahead and sell their receivables or factor them. Factoring, selling is the same thing. And then they don't have to worry about collecting them. They don't have to have a collection department. They don't have to, hire people to collect their debts. They just factor their receivables. So one of the things you would want to gather as an auditor is have they factored any of their accounts receivable? Because it would change the way that they're shown on the books. They would not be shown in the same way as if they were active accounts receivable as if they're factored. And so this is one thing that you'd want to examine. You'd want to inquire of the company, and you'd want to make sure if some are factored that they're handled and shown properly in the financial statements. And that is all for chapter 7. Thank you and have a good day. Bye-bye.